name is James Bogart. I'm Managing Principal of Bogart Wealth. Today I'm going to be talking about Roths versus traditional 401ks and IRAs. Real quick before I get going in the presentation, I do have the question and answer box open. It should be at the bottom of your screen. I also have the chat box open that if you'd like to ask any questions, I'm going to keep those available as we go. Just a quick introduction on Bogart Wealth. Bogart Wealth is a registered investment advisory firm. We are true fiduciaries for our clients. I like to say Bogart Wealth's core competencies are investment management, financial planning, and tax optimization. Not that any one of those three is any more important than the others, but we make it a very important part of what we are, who we are, and what we do to have a full integrated service model. There are 15 members on our team, if I could get the slide to show. Poor Sandra, haven't had a chance to get her photo yet because of COVID, but that's 15 members on our team. We have 3 offices, one up in McLean, Virginia, one in Houston, Texas, and then one in the Woodlands, Texas. Our mission is to help our clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. I do like to say your kids and your parents can be some of the largest variables in anyone's financial plan. We've made it part of our firm's culture to give your children access to certified financial planners. Many of you have heard me say it, but I do like to repeat it. You know, what would you do differently now that you know what you know, but back in your 20s or early 30s? And that's usually when we can have a very significant amount of impact. So today is actually kind of getting back to what we used to do, but it's part of our Retirement Cash Flow Optimizer series. We do 8 different topics more consistently. Historically, these have been live events. With COVID and on the other side of COVID, I'm going to actually make sure that I'm doing them virtually as well. We are recording these events, and we also have the slides available. So if you happen to have any friends, colleagues, relatives that would be interested in any one of our topics, please feel free, send them a recording, send them the slides. We're actually getting ready to, on our website, start hosting these as well so people can have access to them. But we do one on the retirement planning timeline. We do one on retirement income planning, one on Social Security strategies, one on tax planning and tax optimization strategies, do one on estate planning. We also do one on net unrealized appreciation and post-retirement income strategies, one on long-term care and long-term care insurance, and then the one that we're doing today, which is Roth versus traditional 401ks and IRAs. You know, this list came from our audience, so if there's a topic you'd like to hear us talk to or address, please feel free, send me an email or let us know. At a minimum, I'll add it to an existing presentation, and if necessary, I'll make a whole new one. We've been doing that a lot recently as data is constantly changing, whether it's the CARES Act or the Secure Act or anything that's very timely. We're delighted to do a presentation on those. All right, so today we're going to really dive into Roths versus traditional 401ks and IRAs. We're going to start with talking about some of the basics. Then we're going to get into some general conclusions and then talk about some special circumstances. So, you know, with the basics with regards to Roths versus traditionals, you know, we talk about before tax or pre-tax versus after tax. We talk about tax deferred versus tax-free. Then we talk about contribution limits, some early withdrawal penalties and exceptions, and then we'll get into some more details around required minimum distributions. You might hear me call them RMDs. So to start, you know, it's really important to understand the dynamics of accounts. So what we call qualified accounts, which is really talking about traditional 401ks, IRAs, 403bs, or 457s. You know, we talk about some of the benefits of those first. And the benefits really are that you're able to put money in on a before tax basis. So you save taxes every year while you're also saving for retirement. You do not pay any tax on gains or appreciation until you withdraw the funds. You don't pay any taxes on dividends, and then with the traditional 401k, you get the benefit of a company match. There are some negatives, though, to traditional 401ks, IRAs, et cetera, is that if you are under the age of 59 and a half, there's a 10% penalty to withdraw funds. And also every dollar you've put in plus all of the appreciation on the before tax money comes out as ordinary income when you withdraw it. So ordinary income means it's the same as if you earned it. So highest marginal tax rate at that point in time. And then lastly, you do promise to take money out in retirement. So when you reach that magical age of 72, you have to take out required minimum distributions. Very heavy penalty if you miss any of these. It's actually a 50% penalty for any funds that you were required to take out that you actually missed taking out. So very, very mindful of the impact of RMDs and want to make sure that we're planning appropriately for them. All right, so in terms of what we can contribute to retirement accounts, so 401ks, 403bs, Roth 401ks, if you're under the age of 50, you can put $19,500 into these. If you're over the age of 50, you get to do what's called a catch-up contribution, which is an additional $6,500 per year. Now, defined contribution plan limits, so again, talking about 401ks, 403bs, they're capped out at $57,000 of total contribution per year if you're under the age of 50, and if you're over the age of 50, it's $63,500. Now, some people get hung up on this, and so I wanted to just kind of spend a minute on what that really means. So you have the ability, as I was just talking about, if let's say you're over the age of 50, you can put $26,000 in on a before tax basis or into the Roth 401k. Now, typically a company's 401k plan offers a match. So let's just say in that year, based on your income, the match portion is $14,000. So now you've put in 26, the company's put in 14, that brings us to 40,000 total. So what this is saying is if you're over the age of 50, you can actually do an additional $23,500 of after-tax money into the 401k. I'll talk a little bit about why you might want to consider that in a few minutes, but it's an additional way of doing some additional savings within that retirement environment. All right, so this is talking about retirement plans with companies. Now we can also talk about traditional IRA accounts. Now with traditional IRAs, you actually have two ways of putting money into them, non-deductible and deductible. So I'm going to talk about deductible first. Now with deductible IRA contributions, if you're under the age of 50, it's $6,000 per year. If you're over 50, you can do an additional $1,000, so $7,000 total. Now, in order to be able to take a deduction, it depends upon your status of if you're employed or not, and if you have a company retirement plan available to you or not as well. So if you're covered by a plan, meaning you're actively working and you have a 401k plan or retirement plan available to you from your employer, the ability to take a deduction on traditional IRA contributions actually starts to get phased out. So for single people, it starts phasing out at $65,000 of income. It phases completely out at $75,000, and then for married households, it starts phasing out at $104,000, completely phased out at $124,000 of income. Now, if you are if you are a stay-at-home spouse, so if one spouse is covered by a plan, so let's just say, for example, we have one of the husband or the wife is working and they have a 401k plan, but the non-working spouse stays home. Well, the phase out actually is at a higher level. So it's $196,000 is where it starts phasing out, and it completely phases out at $206,000. So what it's saying is if you don't have a 401k plan and you make under $196,000 when you're married, you can actually do a contribution to an IRA and take a deduction. Now, there's this other category called non-deductible. Now, with non-deductible, you can still do the $6,000 if you're under 50,000 if you're over 50. But if you're not taking a deduction, you can make an unlimited amount of money and put that amount into those retirement plan, into the IRA accounts. So one way to consider, and I'll talk about some of this more materially here in a second. Now to compare it, I wanted to talk a little bit about Roth IRAs as well as Roth 401ks. So with Roth IRAs and Roth 401ks, the salary or contribution is done on an after-tax basis. The growth is tax-free. The withdrawals of principal are always tax-free, and then withdrawals of growth are tax-free if you're turned over the age of 59 and a half, and the Roth IRA account has been in existence for over 5 years. Now, if you're under 59 and a half or under 5 years, there is a 10% penalty on the growth portion, but you can always get your principal out tax-free. Now, Roth IRAs are not subject to the math of those required minimum distributions. Remember I talked about with IRAs and traditional 401ks, they are subject to the math, but Roth IRAs are not. However, Roth 401ks are. So you could put money into a 401k plan, into a Roth 401k plan, and again, same limitations that I talked about here a moment ago. However, if you leave Roth 401k money in a 401k plan, that will be subject to required minimum distribution. So it ultimately comes out tax-free. However, if your intent is to grow money and accumulate some of your wealth tax-free, we would, especially when you get to the age of 72, want to make sure you've rolled out that Roth portion from the 401k plan. Now, the nice part about Roth 401ks as well as Roth IRAs is your beneficiaries inherit tax-free. And I'll talk about that a little bit more when it comes to inheritances in a few minutes. Now, contribution limits for Roths are a little bit trickier, for this is Roth IRA specifically. It's still $6,000 if you're under the age of 50 with an additional $1,000 of catch-up, but there's phase-outs of when you can contribute to these. So if you're single, if you make under 124,000, you're in the clear, but it starts phasing out at 124, and if you make over 139,000, unfortunately, you cannot do a contribution at all. For married households, it's 196,000 and completely phases out at 206,000 of income. So something to be mindful of if you want to do Roth contributions, Roth IRA contributions. Now, Roth 401k do not have an income threshold. However, we're going to talk a little bit here in a minute about if that makes sense or not while you're working. Now, the second way to get money into Roth IRA accounts is through what are called Roth conversions. So what this means is that you're actually converting portions of your IRA account over to a Roth IRA account. You're going to pay taxable ordinary income on the conversion amount, but then the growth, once it moves to the Roth IRA, and again, is completely tax-free and also not subject to required minimum distributions. You could probably spend some building up to some of the strategy conversations here in a minute. Now, to kind of just find this concept of pre-tax versus after-tax, wanted to use a real quick example. So let's assume you're married and each of you earns $80,000 a year, so $160,000 combined income. Your marginal tax rate is 22%. So let's say you've got $20,000 to fund to a 401k this year. With a traditional 401k, you save 20 grand and your taxable income reduces. So remember, I said it's on a pre-tax basis. So your 160 of combined income now drops to 140. Now, with a Roth, you actually would save $15,600 because it's after taxes. So your taxable income would still be listed at 160. Now, let's start applying some hypotheticals here. So let's just say after 30 years and 8% returns, the traditional balance would be at 2.265 million. The Roth balance would be at 1.767 million. So the key point here is your savings come from the last dollars you earn. So if you're putting it on a before tax basis, it's reducing your taxable income at those highest marginal levels. So let's build on this example a little bit more. And again, just carrying those numbers over the balances. So for a 30-year retirement at, now let's just say 6%, you can withdraw from a traditional IRA $164,598 per year. A Roth, you can withdraw $128,386 per year. So if tax rates were completely flat, right, you were just paying the same amount in taxes as what you were assessed at the highest marginal, the traditional amount after taxes, because remember, when you take money out of a traditional IRA or 401k, you got to pay taxes, and your traditional amount would actually be $128,386. That's 78% of the 164. Whereas with the Roth, because it's tax-free, it's also $128,386. Now, what this is saying is that if tax rates are the same, there's absolutely no difference between doing Roth savings versus traditional savings. But we know that that's not the case. We have a progressive tax bracket. I'll talk about that here as well. So will the tax rate really be 22%? So again, if your total income is that 164,589, then if your current marginal tax bracket is 22%, your average tax rate, so what you actually pay, your effective tax rate is actually 17.1. So if that's the case, then the amount that you can take from a traditional IRA or 401k would actually be $136,452. So it's really 82.9% of the original 164. Now, the question ultimately becomes, what are your tax rates now versus what are they going to be in the future? You know, income taxes ultimately will need to rise by about 34% for a Roth to be able to break even if you're doing a tremendous amount of savings at the highest marginal bracket. So if your tax rates are lower in retirement than they are while you're working, then it absolutely should be favoring doing savings into a traditional 401k environment. Now, this is a great little chart that Pete built for us. Pete's one of our advisors, but it's showing on the x-axis is the average tax rate at retirement, and the y-axis is the marginal tax rate. And there's a clear delineation that if your average tax rate is the exact same as your marginal, then there is no benefit. But if your marginal tax rate is lower than your average, then clearly it makes sense to favor doing traditional 401k contributions. Now, on the flip side, and especially for like your kids, they might be in a low tax rate early on. And so if their tax rate is going to be higher in retirement than where it is today, then it's going to favor doing Roth 401k savings. So there clearly is a pivot point where it makes sense to look at doing Roth 401k early on. And then as your income goes up and your tax situation changes, it's going to pivot over to favoring doing traditional 401k savings. All right, so we talk about the progressive nature of our tax brackets. We know that our tax brackets go from 10% to 12% to 22 to 24 to 32 to 35 to 37. And going back to that example I did earlier, if someone's at the top end of the 22% tax bracket, that means that their effective tax rate, average tax rate, is 17.1. So that means that the amount that you're actually going to pay in taxes is 17.1%. It's not 22%, even though that would be where the last dollar that's being taxed is at the 22% bracket. So the progressive nature of our tax brackets, because they go from 10 to 12 to 22 to 24 to 32, 35 to 37, that favors savings in the traditional 401ks, especially if you're in these higher tax brackets. And it's important to remember your withdrawals, when you take them out, are at the average tax rate. All right, so just wanted to rehash contribution limits. So again, with 401ks, if you're under the age of 50, you can do $19,500 plus an additional $6,500 of catch-up. Now, there are no income limits to do Roth 401k contributions. So you could be in a high tax bracket and still do Roth 401k contributions. However, it might not make sense. And that's really the point that we're trying to make here. With IRAs, as I already talked about, $6,000 if you're under the age of 50, an additional $7,000 of catch-up. But there are income limits to do contributions to Roth. So be mindful of that if you're trying to do straight contributions into a Roth IRA. There are no income limits, though, on Roth conversions. The only limitation ultimately is your desire, your ability, your willingness to write a tax check. So you could theoretically convert $1 million IRA account over to a Roth, but you're going to pay a lot of taxes to do that. Ultimately, our objective with developing tax optimization strategies is to keep more money in your pockets, and that's both now and lifetime. Now, I could make a compelling argument that if you're in a low bracket in the early years of retirement, then it might make sense to look at doing conversions early on in order to be able to bring down the required minimum distribution amount in the future. We've got some examples coming up of this that might help drive this point in. Now, it's also important to note that you can contribute to both Roth and traditional, but the total combined balance has to stay the same. So like, for example, with the retirement plan, if you're over the age of 50, you can put 26,000 in. You can do 13,000 to the Roth 401k and 13,000 to the traditional 401k. You're just capped at that $26,000 threshold. Same goes, we can contribute to both a 401k as well as an IRA. Now, there is no deduction for the IRA if you're over those income thresholds, as we already talked about. We do favor the first place that we want to see savings to happen to be at the 401k, because you're also going to get the higher contribution limits, but you get the company match. So it's a kind of added sweetener. Now, another piece of this is to talk about early withdrawal provisions, both from 401ks as well as with IRAs. Now, what this is talking about is if you're under the age of 59 and a half and trying to retire, if your money is sitting in an IRA account, there is a penalty to withdraw prior to 59 and a half. Now, there are some additional provisions to this. Now, one tangent to just make is 2020 is an anomaly in that the CARES Act did eliminate the ability to take money out of retirement accounts with penalty. You still have to pay ordinary income, but it eliminated the penalty because of COVID-19. But we are talking more in a macro environment, where things are at, once we get back to normal. But if you withdraw money from a IRA account under the age of 59 and a half, you do pay a 10% penalty. Some exceptions are you can pull money out for education. You can pull money out using what's called a 72T, which is a tax provision that allows you to take out what they call substantially equally periodic payments. So for 5 years, you have to take out the exact same amount from a retirement account. You can take money out for medical. You can take money out for your first-time home purchase. Now, Roth contributions and conversions are penalty-free after 5 years. Now, with 401ks, slightly different rules, but also there's just an additional exception. So same thing, if you're under 59 and a half, still a 10% penalty. But the new exception is that if you've retired after the age of 55 and separated from service, you actually can take money out of a retirement plan once a year, penalty-free. You also have the 72T provision available to you. You also have medical provision available to you. And the Roth is the same as the traditional in terms of the rules there. But one of the conversations we have to have for anyone who's retiring under the age of 59 is how do we bridge them to 59 and a half? And one of the strategies might be we leave your savings plan at your 401k to be able to pull money out penalty-free. Still pay ordinary income, but we pull the money out penalty-free if you've left there after the age of 55. Without a doubt, this is a very important concept. If you're retiring under the age of 59 and a half, we need to have a withdrawal strategy. It's very, very important to have that withdrawal strategy. All right, I've already talked a little bit about required minimum distributions, but just to kind of reemphasize these, RMDs start at age 72, and now this is a percentage that is determined by a life table, and I'll show that here in a second. That percentage does increase every single year with age. Now, you obviously can withdraw more, but that's the required minimum amount, and any amount underneath that is a 50% penalty. Now, RMDs apply to traditional IRAs, traditional 401ks, as well as Roth 401ks. They do not apply to Roth IRAs. Now, you can roll a Roth 401k over into a Roth IRA so that the Roth IRA is not counted in the math. But ultimately, if the purpose or intent is to have tax-free growth, then we want to make sure that we are incorporating the holistic profile, including if you have Roth 401k money, let's not leave it at the savings plan once you hit 72. Now, here's the RMD table. Now, this table actually has a proposal in place to change the table. So currently, the distribution table starts, as we mentioned, at age 72. So it's 3.9% of the retirement account balances have to get withdrawn. Now, under the new proposed table, which is not quite passed yet, that percentage drops to 3.7. So the life factor adjusts. Now, in order to calculate required minimum distributions, what happens is we look at the balance of the retirement accounts as of December 31st, and then these of the year prior, and then these life factors are determined or imposed, and that will also then determine the amount for what the RMD is. Now, also because of CARES Act in 2020, from January 1st until December 31, 2020, RMDs have been waived for the year. So retirees are not required to take money out this year. Now, ultimately, most people need to have the money coming from the retirement accounts for cash flow purposes, but there's not that minimum threshold that they need to be. Now, one thing I mentioned a moment ago is that percentage for RMDs increases every single year. And so presumably, if you're in an environment where you don't need these, and all of a sudden we get to a point where in your 80s that's 6, 7, 8% of the retirement account balance, well, that can start creating an environment where it's forcing your tax rates to be higher and higher and higher. If you're very fortunate and you can live to 115, then you're actually going to have to take out 52.6% of the account balance. So it's very, very, very significant. Now, under the new table, it goes down a little bit to be 34.5%, but ultimately that's still an extremely large amount from a retirement account, and something that can absolutely drive higher and higher tax rates. You know, one of the things that we talk about from a tax optimization perspective is we want to make sure that we're looking at what your spending needs are, and then looking at the effective tax rate associated to that. So if we're in a situation where your tax rate is, or tax bill is going to be 50, 60, 70, 80, 100% of what you want to spend, then we need to talk about planning strategies ahead of that to be able to manage that and hopefully reduce the burden. So we'll kind of talk about general conclusions, and then I'm going to get into some strategy stuff. So when we talk about 401ks versus IRAs, we do want to use the 401k before considering an outside IRA account. You get the higher contribution limits, you get the benefit of the employee match, and then for certain companies, specifically ones that we work with a lot is ExxonMobil, there's something called net unrealized appreciation for any employer stock. And we have a whole presentation on NUA if that's something you'd like to talk about. But factors that are going to favor the Roth 401k. So if income rates will be higher when you retire than they are now, we should be doing Roth 401k. If you expect your salary and spending to go up significantly faster than inflation between now and retirement, let's do the Roth now and then switch over to the traditional later. If income rates all go up in the future, we should be doing Roth IRA or Roth 401k now. Now, as a side note, by the way, we know with no legislative reform in 2026 that the tax rates are going to sunset back to what they were, which is about 3% higher than where they are today. Also, if you believe that you're going to be in what we affectionately call RMD prison, then we should talk about strategies for using Roths early on. And what RMD prison means is that your RMDs, your required minimum distribution amount, is larger than you want to be, and it's driving your tax rates up. And then lastly, if you anticipate leaving a large legacy to your family, your kids, one of the best ways to do it is in Roth accounts. Now, a little bit of a tangent. The Secure Act passed at the end of 2019, and what this did was it changed the way that your heirs can inherit retirement accounts. Specifically, prior to the Secure Act, they were able to take them and stretch them out over their lifetimes. Now, under the Secure Act, your beneficiaries are now required to take them out over a 10-year period of time. And so if there's a meaningful amount of money that's being left behind, ultimately, if we leave it in a traditional IRA or 401k, they're going to have to take it out and pay ordinary income. Whereas if we leave it to them in a Roth IRA, they do not have to pay any level of income on it. It goes to them tax-free. Still subject to the 10-year rule, but it comes out to them tax-free. All right, some factors that favor traditional 401ks. If income taxes are going to be lower in retirement versus now, we should do traditional 401ks. The progressive tax brackets favor traditional, which we've already talked about that. Any future tax law changes, like if we see a flat tax, that means a lower rate overall, or if we see a national consumption tax or a VAT tax, that favor traditional over a Roth. If you anticipate needing to draw down all or nearly all of your retirement savings, in other words, required minimum distributions are not an issue for you, then we should absolutely just continue on, do traditional 401k savings. And also, if you have the intent of leaving a large legacy to charity, then leave it in the IRAs or 401ks, let the charity inherit those, and no big deal, because they don't pay taxes on them. So we're going to talk about a little bit about special circumstances. And I've already kind of alluded to this, but when we talk about surplus RMDs, and I called it that RMD prison, basically with IRAs, you have two scenarios. Either if you live long enough, you're either going to completely deplete the IRA, or you're going to have required minimum distributions that are larger than your living expenses. For most people, it would take a really large RMD surplus to make the average tax rate surpass the marginal tax rate. However, we see it happening a lot, and it's all relative to your situation. And that's why long-term planning is so important. And so if you're in the situation where we see large surplus required minimum distributions, we should either consider a Roth 401k now, or consider Roth IRAs or conversions now, but also consider IRA conversions after retirement, but prior to the age of 72, and maybe even after 72 if we've done our planning right. And then also one of the other strategies is just consider gifting money to the kids now. For example, fund a Roth IRA for them if that's something that's important to you. But keep in mind, a Roth IRA must be in existence for 5 years before the tax-free growth starts to accumulate. Neat little flow chart here that just talks about some of the decisions associated with current tax environment versus future tax environment. And really what we're trying to demonstrate here is that do you think that you will be in the same bracket or higher in retirement? If the answer is yes, let's look at the time horizon. And then ultimately, if the time horizon is 5 years or more, then we need to look at what your tax payments are. And then it's going to then derive if we want to look at doing Roth conversions or not. At the end of the day, if you're working with an advisor, let them help you with the math here. This is partially why we rely so heavily on planning, because this is a very integral part of some of the long-term planning and tax optimization work that we do. And here's kind of an example of this. So this is a household that's working this year. They're in a high bracket now, but when they retire, all of a sudden, they're going to drop from being in a high bracket to being a very, very low bracket. And people say, why? Well, if you've got money sitting in after-tax accounts, checking accounts, brokerage accounts, money market accounts. Well, you can use that to fund your cash flows, and that ultimately is going to bring your taxable income very, very low. In this example, it takes them all the way down to the 10%. However, once we've depleted that, we start getting to a point where they're in the 33% bracket because they're now drawing off of their IRA accounts. And then ultimately, as those RMDs are continuing to increase every single year, they get into the 35% bracket. And then this example is actually when husband dies and the wife's a little bit younger, it drops back to the 33% bracket. I had a question come in real quick. If the retiree dies, then does the surviving spouse have to comply with the RMD? Same table continues or reverts to her age? Great question. Actually, I'm going to address this in a minute, but I'll hit it now. So it depends on what type of beneficiary the person is, whether they're a spousal or non-spousal beneficiary. If it's a wife, she has a choice. She can either do it under your RMD table or can do it under her own RMD table. It really depends if she's older or younger. Sometimes it makes sense for her to convert it to her. Sometimes it makes sense to leave it in the husband's, as an example. But that's another area that we can help as well. So going back to this Roth conversion strategy, if you're in a situation where we see tax rates dropping for a period of time, but then we ultimately know that they're going to increase, then why not consider doing some Roth conversions in this window of time here? And here's just kind of a basic example of showing this. You know, initially, this person does not have a whole lot of Roth assets. And our recommendation is to go ahead and look at, while we're in those low years, converting about $700,000 of IRA money over to Roth IRAs. We're going to do it incrementally, making sure we keep them under the 24% bracket. But all of a sudden, the level of wealth that transfers, it significantly increases the amount that's going to the kids tax-free. Whereas it ultimately increases the total amount because it reduces the tax burden. But ultimately, the kids are going to love you a lot more. But along the way, we've done a really good job of saving some money for taxes for you. Now, here's the kind of the comparison of showing the RMD tables. And this is just modeling what this person's RMDs are going to be starting at age 72 if they do nothing. Whereas if they go ahead and do some bracket bumping in those low bracket years, well, next thing you know, we're significantly reducing, as you can see with the yellow curve, the amount of required minimum distribution amounts. To this household, it was about a $1.688 million difference in lifetime required minimum distribution options. Now, ultimately, that's not necessarily what you care about. What you care about is the tax comparison. How much money are you saving in taxes? And so this is where we're, again, showing where we're going to go ahead and pay some tax now, again, yellow bar here, but we're reducing the lifetime burden. And so, again, with doing $700,000 of conversions, we've actually, over the lifetime, saved $518,000 in taxes. That's meaningful. And again, now we're talking about an additional $3.5 million that's going to go to the heirs tax-free as well, which is just an additional fringe benefit. And so what we do is we look at the effective tax rate and model that out. Whereas, you know, while we're in those base case, if we do nothing, we're going to be in a low effective tax rate, but we're doing some conversions. We're making the decision to pay some tax now. And ultimately, we have some latitude to even go a little bit higher in this case if we wanted to. But we're monitoring that religiously to then determine kind of the lifetime obligation. So the point is, Roth conversions make sense and absolutely should be part of a retirement plan, especially if you're going to have a window of time where you're going to be in a very low tax bracket and ultimately, you know, your RMDs are going to put you into a higher one. And by the way, this doesn't always even apply just to people who have big after-tax assets to be able to use to bridge this. Let's say you need to rely on your retirement accounts, but ultimately, remember, those RMD percentages are increasing every single year going forward. And so it might even make sense, even if you're taking money out of the retirement accounts, to look at doing some incremental bracket bumping every single year until you turn to those required minimum distribution ages. Like, for example, what you need might put you in the 22%, but those RMDs in the future might put you in the 33 or 35. Well, maybe you do some conversions all the way up to the 24% bracket now. Get that money out of calculations for the RMDs and growing tax-free. So all great examples here. Okay, we get asked the question a lot, should I do 529 plans, which is a college savings plan, versus saving in a Roth IRA for education expenses? Now, 529s have a lot of different advantages. There's no income limit on contributions. There is no tax on withdrawals for qualified education expenses. there are annual contribution limits are much, much higher than IRA accounts. So you can gift to a 529, 15,000 for husband, 15,000 for wife, so 30,000 combined. And they actually allow you to do 5 years front loaded at once. So if you want to do 150,000 all in one shot, you can do it. You know, if you're really wanting to set the grandkids up and you know that the legacy is important to you, something to consider. I'm working on my dad for that. We'll still keep trying. Some limitations, now taxes and penalties if expenses are not pulled for qualified plans. And then also considered assets, the 529s are considered assets on a FAFSA form, so student financial aid. Now, along those lines, what I would always say is if grandpa and grandma are doing these for grandkids, grandpa and grandma need to own the 529s. Don't put it in the kid's name and then fund it, your kid's name to fund it for your grandchild's benefit. Keep it in grandpa and grandma's name because it allows us some flexibility to still put the kids potentially for financial aid if, let's just say, your son or your daughter is in a much, much lower bracket and ultimately they would qualify for financial aid on their own. If grandpa and grandma own the 529s and ultimately the funds are going to be used, we buy a little bit of time to still be able to get some of that financial aid qualification. Along those lines, though, there are limitations, as I said. So any money that gets pulled out, not for qualified education expenses, taxes and penalties. So we don't necessarily want to overfund these. Let us help you or a financial advisor help you model what you should be saving within a 529 plan. In terms of funding, though, I would always say fund the 529 first. To avoid overfunding it, let's look at Roth contributions or conversions that can be withdrawn tax and penalty free for qualified educations off of if we get to that higher threshold. So a great example of this is, let's just say we don't know if the kids or grandkids are going to go to in-state tuition versus an out-of-state public university versus an Ivy League. And maybe you're only comfortable funding up to, for example, in-state because ultimately that could be the base case. Well, then if that's the case, let's do that amount into the 529. And then on top of that, let's go ahead and do the Roth if that's appropriate. It could supplement any of these savings requirements. All right, I already hit this real quick. In terms of savings for the employee, one of the things that I want to make sure we do is max out the 401ks first. So get the money in on a before tax basis, especially if you're later in the career, bring your taxable income down. Now, if you have the ability to do savings outside of the 401k plan, let's look at doing some strategies outside of it. So next up should be consider doing an IRA contribution outside of the plan. So one of the options that we've seen, it's a very phenomenal strategy for employees who are actively working that do not have IRA accounts, is this concept called backdoor Roth contributions. Now, with backdoor Roth contributions, what we're doing here is we actually have, we put money into an IRA account, and then it's on a non-deductible, so it's after-tax money. We did not take a deduction, and then we immediately convert it over to the Roth IRA. That makes it completely tax-free. Now, this strategy only works for those that do not have IRA account balances. So let's just say husband or wife, they're the active employee. If the active employee doesn't have an IRA account outside of the 401k, then this is a great strategy. You know, and as we mentioned, we can do 7,000 if you're over the age of 50 per year. And by the way, the tax filing deadline for 2019 has been extended until July 15th. So if you haven't done one for 2019, great strategy, still can get that done. You could ultimately do 2020 as well. Now, the critical thing with filing your taxes on this is you need to declare this IRA portion going into the IRA, and you need to declare that it was done on an after-tax basis, because that's what establishes what's called basis, generates a Form 8606, which allows the conversion to be tax-free. If you don't tell them that you did the IRA portion, then they're going to consider that conversion as taxable, and they can zing in taxes for that. I had a question come in real quick. Doesn't the 529 owner have to specify a child or provide their social security number? Wouldn't the account count against financial aid, even if it's in the grandparents, uncles, aunts' name? The answer is yes, you absolutely have to have a qualified beneficiary on 529 accounts. But there is leniency on FAFSA forms, because what happens is grandpa and grandma do not have to pull that money out for that specific beneficiary. They can ultimately always change that beneficiary to anyone else that's considered a qualified beneficiary for education purposes. So what happens is let's just say, for example, first year of college gets paid for with financial aid or student loans. And then ultimately what we could do is then have grandpa and grandma pay for year two. That wouldn't hit the FAFSA form, or the source of funds wouldn't hit the FAFSA form until year three, which wouldn't then at that point deem them for a reduction. So it's just some optimization work that we can do along the way. But just because you deem a beneficiary and you list their social does not necessarily disqualify them for financial aid purposes. All right, beneficiary options. I did talk a little bit about this briefly. Now, under the Secure Act, they did change the way that beneficiaries are categorized. We've got three categories now, what are deemed eligible designated beneficiaries, and non-designated beneficiaries. So an eligible designated beneficiary is going to be a minor child of the decedent. It's going to be a disabled person. It's going to be someone who's chronically ill, someone who's not more than 10 years younger than the decedent. It's spouses as well as certain trusts. So essentially, this is the category that nothing changed for them. They have the ability to take money over, put it into their name, as I answered that question earlier, or they can leave it in the respective person's name. Designated beneficiaries, this is where those new rules change. So essentially, this is non-spouses, so your kids, or certain types of trust. And this is now, as I mentioned earlier, where for IRAs and Roth IRAs, they've got a 10-year window, they've got to take it out. And then if we happen to not list a beneficiary on a retirement account, or it's a charity, or you just have your estate inheriting it, could even be certain types of trusts, the old 5-year rule still applies. It means that those people have to cash the IRA account in or 401k account in within 5 years. I saw another question come in. I'm going to hit a couple other things and then I'll come back to that. All right, so inherited Roth IRAs. So both your Roth IRA, as we mentioned, does not have an required minimum distribution. However, your inherited Roth does. So as I mentioned, if the kids inherit it, you got 10 years, they got to pull it out. Now, spousal beneficiaries do have the choice, though. They can roll it to their own Roth, no RMD. They can treat it as an inherited Roth IRA to avoid 10% or pre-59.5 penalties if they're significantly younger. Now, non-spousal beneficiaries always have to treat it as an inherited IRA. Now, withdrawals from an inherited IRA, they can begin at any point in time. There is no 10% penalty as long as it's within that 10-year window of time. So one thing I would say is if the kids are going to inherit Roth, make sure they wait 10 years, get the additional 10 years of tax-free growth if they can avoid it. If they've got other buckets that you're leaving to them, let them spend those first. You know, it's hard enough to get money into Roth, let it grow, continue to grow tax-free. But everyone's circumstances are going to be different. Let's help with what makes the most sense. With traditional IRAs, it's the same with the Roth IRA, except you have to pay taxes. Now, if it comes out as a lump sum distribution, it's 100% taxed. Now, as I mentioned earlier, spousal beneficiaries, they have a few restrictions. They can roll into their own IRA at their own RMD schedule, or they can treat it as an inherited IRA and continue on the same schedule. Non-spousal beneficiaries, unfortunately, they no longer can stretch it out over their life expectancies if they're non-spousal, unless they fall into that eligible category. So they're chronically ill, minor child, less than 10 years, et cetera. But everyone else, they've got 10 years and you got to cash it in. So if you're in the fortunate position where you're going to be leaving your kids some money, let's just say it's $2 million, and ultimately they've got 10 years to do it. That means that the kids are going to be pulling out $200,000 a year minimum, or they're going to just have one really, really big year. Now, if that's at their brackets, a lot of times what happens when they're inheriting these retirement accounts is it's typically at the later ages of their career. And ultimately, it could force some of this money coming out at higher brackets. That can be very, very painful. We want to make sure we plan for some of this stuff on the front end. So consultant advisor, there's a lot of decisions that need to go into traditional versus Roth. We need to look at your current marginal rates versus what we're projecting for the future. We need to look at Social Security. We need to look at savings, where we're doing it. Should it be in a tax qualified environment? Should it be in an after-tax environment? What do we expect your future required minimum distributions to be versus expected living expenses? What are future tax law changes and how can that have an impact? And also some of those estate planning and legacy considerations. Now, one of the calls to actions from any of these talks that we do is we do offer absolutely no cost, absolutely no obligation financial consultations. We're more than delighted to build a financial plan for you. You know, our hope is that we can add significant value to your situation. And if there's anything we can do to help with optimization along the way, we're delighted to do. And as I mentioned, no cost, no obligation. We'll reach out at the end of the seminar and see if you have any questions, and please let us know if you'd like to visit. And this is the contact information for my team. As I mentioned, we are a resource. Our why is to educate. We're delighted to do these things and delighted to offer those plans for you. I wanted to make sure I came back to this question. Can you do backdoor IRA to Roth every year? Is the only criterion that you do not have any other IRA account? The answer is yes. You can do it every single year as long as there is no IRA account balance. Now, the caveat to it, though, is you need to have earned income. So if you've retired and you no longer have earned income, then ultimately you're not going to be able to do it then. But while you're still actively employed, yeah, absolutely, you can do it every single year. And if you're doing things like gifting to the kids and they have earned income, great. Now, if you have kids that are still in college that don't have any earned income, unfortunately, we're not going to be able to even do Roth IRA contributions for them. They need to have earned income in order to be able to take advantage of these things. All right, that's all I see in terms of questions, but delighted to be a resource. Please let us know if there's anything we could do, any questions you have. I apologize, I went a little longer on this one, but have a great day, stay safe, stay well, and please feel free to use this as a resource however we can be. Thank you.